Hello, and welcome to myfinanceteacher.org. In this video, let's have a look at our fundamental valuation of a couple of gold miners. But before that, let me remind you that if you want to have access to my analysis of other assets, we look at energy, precious metals, the general stock market, cryptocurrencies, and a range of other commodities. Feel free to join us at myfinanceteacher.org. You can join us by clicking this register button. Now let's jump into the valuation, and today we're going to have a look at GoldFields and B2 Gold. As usual, my fundamental valuation is based on the three scenarios for gold price. It's also based on the reserves and the resources that the gold miners have in the ground, on the costs of extracting those reserves and resources, on the long-term debts, taxes. The value is calculated per share, so we look at the number of shares outstanding. We also take into account the time value of money, and I throw in a little bit of a secret sauce on insider shares, where insider participation is a benefit, as those might have some insider information. By the way, today is 25th of March, and this analysis will probably go public in 2 or 3 weeks on YouTube. If you want to have immediate access to all of my analysis, join us at myfinanceteacher.org. As usual, the three scenarios for gold price are $1,600, $1,800, and $2,000 per ounce. Looking at the reserves, GFI has 52.1 million ounces in PNP reserves and 63.9 million ounces in resources. Usually in my model, I look at M&I resources, but GFI doesn't actually show the split between their measured and indicated and inferred resources. So in this case, the resources includes everything, including the inferred resources. For BTG, they have 5.43 million ounces in reserves and 8.57 million ounces in M&I resources. As you see, the slides are sometimes a little bit cluttered, as this slide here as well. And that's because I try to show you where the data comes from, mostly from company reports, news updates, and Yahoo Finance. Coming back to the BTG resources, the company hasn't actually reported their December 2020 results for the resources and reserves yet. So instead, I took their most recent numbers for December 2019 and subtracted the production they had so far in 2020 from their PNP reserves. Looking at the all-in sustaining costs, for GFI that's $1,040 per ounce, and for BTG that's $890 per ounce. These numbers are from 2021 guidance. For long-term debts, GFI actually holds a lot of debt at over $1.8 billion. So there is quite a lot of leverage with GFI. Perhaps if precious metals continue down from here, perhaps that might be a little risky for GFI. BTG has relatively small debts at under $76 million. I will assume a tax rate of only 20%, but I do lean into a conservative valuation in other areas, such as we don't include full reserves in our calculations. Hence, I think a 20% tax rate across the board for my model is more or less okay. Hence, we are looking at the reserve value in the ground after the cost of extraction, after debts, and after taxes. That's basically the main gist of the model. Of course, the model shows valuation per share, so we'll look at number of shares outstanding, which is 883 million for GFI, with 0% in insider hands. And BTG has 1.05 billion shares outstanding, with nearly 1.2% in insider hands. Looking at the time value of money, I'm going to apply a discount rate of 5%. I'm going to apply that to the average life of reserves and resources based on the production guidance for 2021. And for GFI, the average mine life of proven and probable reserves is around 22 years. If you add only half of the resources for GFI, that brings this average mine life to 36 years. Again, this actually includes measured and indicated as well as inferred resources. Actually, half of those resources, as I try to lean conservative in my evaluation and then apply a weight of 0.5 to the less certain resources as opposed to more certain reserves. For BTG, the reserves are expected to last for around 6 years, And if you add half of the M&I resources, all of that is likely to last for around 10 years at expected 2021 production levels. So with all of the data above in mind, we arrive at our conservative valuation, which again plugs in the gold price of only $1,600 and only values proven and probable reserves of the company. That gives you a conservative valuation for GFI of $14.7, which is already showing an interesting undervaluation of over 60% versus the ongoing market price just above $9. So perhaps GFI is kind of interesting here. For BTG, the conservative valuation is nearly $2.5, which is showing a risk level of around 45% versus the market price of $4.5, meaning that if precious metals continue down to the more or less fundamental value of the resources in the ground, would be around $2.5 for BTG. Remember, however, that any sort of analysis cannot foresee the future. There are a lot of other fundamental factors not taken into account, such as, for example, perhaps future management decision to dilute the shares and print more shares outstanding. But as the things stand now, this is my valuation. Moving on to the balance scenario, we plug in the gold price of $1,800 and we still only look at the value of proven and probable reserves in the ground. That gives you a balanced valuation for GFI of around $20.3, which is an interesting undervaluation of over 120%. And the balanced valuation for BTG is $3.2, which is still showing a risk level of around 29%. And looking at the optimistic valuation, we plug in the gold price of $2,000 per ounce, and we'll look at the value of proven and probable reserves, as well as only half of the company's M&I resources. Again, for GFI, that's not only M&I resources, that includes half of all of their resources, including inferred resources. So if you want to bring this number in line with how my valuation model usually works, perhaps we want to subtract this number by $2 or $3. Even then, there seemed to be an undervaluation of over 200% versus the ongoing market price. And for BTG, the optimistic valuation is nearly $6.4, showing an interesting undervaluation of 42%. So that's based on the data described above. Let's actually look at the technicals, looking at the chart. The gold line here is the price of gold, blue line is GFI, red line is BTG. While gold rallied from March 2020 into summer last year, GFI outperformed gold to the upside by a factor of 6, and BTG outperformed gold to the upside by a factor of 4.2. Since summer, while gold dropped down into the March low, both GFI and BTG actually underperformed gold. They dropped more than gold by a factor of 2.2. And connecting the lows, March 2020 to March this year, GFI still outperformed gold by a factor of 6.5, a lot of leverage here, and BTG still outperformed gold by a factor of 3.9. So looking back at, say, optimistic valuations, are these numbers achievable? Well, if gold price does go back above $2,000, say, into the second half of this year, and if GFI and BTG outperform gold by, say, a factor of 4, then while reaching the price level of around 30 for GFI can be quite difficult, there might still be a very promising gain if precious metals strengthen over the next several months. Lastly, let's have a look at the highlights that didn't go into the valuation model but might be important for you to pay attention to. Firstly, both of these companies pay a relatively attractive dividend with a yield of over 3.4%. Secondly, one of the development projects of GFI, Salares Norte in Chile, will start producing in the first quarter of 2023, so that could be an interesting long-term driver for the share price. And as I mentioned before, the GFI valuation includes inferred resources in addition to measured and indicated resources. Usually I do not include the inferred resources, so perhaps you want to cut the optimistic valuation by a few dollars. Moving on to BTG, they have a very nice cash position of nearly $500 million, which is several times larger than their long-term debts. So that's a pretty compelling factor over here. And secondly, a shorter-term driver for BTG could be this upcoming definitive feasibility study, DFS, for the Gramalot project in Colombia. This study is actually expected sometime in April this year. So that concludes this video. So let me leave you with this question. If you only had to choose one, which one would you choose? GoldFields or B2Gold? Let me know in the comments below. While you're there, remember to hit that like button, subscribe to the channel and share this video with your friends. For now, I wish you a wonderful day and good luck in your trades.